Hello and welcome to the session. Financial Reporting LO4 interpret financial statements of an incorporated organization to achieve performance metrics. How can interpreting financial statements enhance an organization's performance? This video explores the critical role of financial statement analysis in achieving performance metrics. Discover how insights from these statements support decision-making and strategic planning. Interpreting financial statements is crucial for evaluating performance and managing resources. These statements provide insights beyond mere figures. They support performance measurement and strategic planning. Shareholders and investors rely on interpreted data to assess profitability and risk. Clear interpretation ensures meaningful information for informed decision-making. Cash flow statements show actual cash inflows and outflows. Unlike income statements, they focus on liquidity and cash management. They help assess if an organization can meet obligations and fund growth. Analyzing cash flows identifies cash pressures and profit sustainability. This is crucial for understanding financial health. Performance metrics convert financial data into measurable indicators. Key indicators include profitability, liquidity, efficiency, and solvency. Profitability measures returns from revenue and assets. Liquidity evaluates short-term financial stability. Efficiency and solvency indicators assess resource use and long-term financial risk. Different stakeholders focus on different metrics. Shareholders prioritize profitability and investment returns. Lenders focus on liquidity and solvency. Management uses a balanced range to monitor performance. Selecting appropriate metrics aligns with stakeholder expectations. This supports strategic planning and decision-making. Ratio analysis interprets financial statements to assess performance. Ratios provide insights into profitability, liquidity, efficiency, and investment performance. They support informed decision-making when used correctly. Ratios should be compared against benchmarks for meaningful analysis. Limitations exist, and ratios should not be viewed in isolation. Profitability ratios measure profit generation from revenue and resources. Gross profit margin assesses cost control in production. Operating profit margin shows management of operating expenses. Net profit margin indicates overall profitability after expenses. These ratios provide insights into cost efficiency and profitability. Liquidity ratios assess the ability to meet short-term obligations. Current ratio measures short-term financial stability. Quick ratio focuses on immediate liquidity excluding inventory. These ratios indicate financial stability and risk. Strong liquidity reduces financial risk and supports operational efficiency. They are crucial for assessing financial health. Activity ratios evaluate resource efficiency. Inventory turnover indicates stock management efficiency. Receivables collection period measures cash collection efficiency. Investment ratios focus on shareholder value. Earnings per share and dividend yield assess investment returns. These ratios support performance evaluation and investment decisions. Interpreting ratios reveals insights into financial health. Strong profitability ratios suggest cost control effectiveness. Liquidity ratios highlight the ability to meet obligations. Efficiency ratios reflect resource use efficiency. Investment ratios indicate shareholder value and market confidence. Ratios provide a comprehensive view of performance. Benchmarks make ratios meaningful. Time series analysis identifies trends over periods. Competitor benchmarking compares performance with similar organizations. Internal benchmarks assess performance against targets. Sector benchmarks evaluate competitiveness and efficiency. Multiple benchmarks improve evaluation reliability. Ratio analysis has limitations. Ratios are based on historical data and may not reflect current conditions. Differences in accounting policies affect comparability. Non-financial factors like customer satisfaction are ignored. Ratios can be distorted by one-off events. They should be used as indicators, not definitive measures. Using financial statements, ratios are calculated to assess performance. Gross profit margin shows cost control effectiveness. Operating profit margin indicates operational efficiency. Current and quick ratios assess liquidity. These calculations provide a basis for evaluating organizational performance. Interpreting financial statements assesses performance against benchmarks. Profitability ratios show strong performance. Liquidity ratios indicate financial stability. Efficiency ratios reveal operational efficiency. Investment performance is assessed through earnings per share. This interpretation supports informed decision-making. Comparative evaluation involves more than calculating ratios. It assesses performance against industry benchmarks. Profitability ratios show strong performance. Liquidity ratios indicate financial stability. Efficiency ratios highlight areas for improvement. This evaluation supports investment decisions. Critical evaluation highlights areas for improvement. Strong profitability indicates cost control. Liquidity ratios suggest financial stability. Efficiency ratios reveal areas for operational improvement. Investment indicators support shareholder confidence. Recommendations are made for enhancing effectiveness. Recommendations focus on improving effectiveness. Strengthen credit control to improve cash flow. Review working capital management for efficiency. Reinvest excess resources in growth initiatives. Align financial performance with long-term objectives. Integrate financial and non-financial performance measures. Ratio analysis is powerful for interpreting financial statements. It supports performance assessment when used with benchmarks. Ratios are indicators, not definitive measures. Professional judgment is essential for comprehensive evaluation. Ratio analysis should complement strategic analysis. In conclusion, interpreting financial statements is essential for assessing the performance of an incorporated organization and achieving key performance metrics. By analyzing financial data such as profitability, liquidity, efficiency, and solvency ratios, stakeholders can evaluate how effectively the organization is operating and identify areas for improvement. Effective interpretation supports strategic decision-making, performance monitoring, and long-term planning. Understanding financial statements therefore enables organizations to measure success accurately and make informed decisions that enhance overall performance. Thank you for watching this video. If you have any questions, please feel free to contact us via email or WhatsApp at 074-8436-1688.